welcome to Talking Money with Nozi, personal finance made simple. Today we're going to be speaking about income from your investments. What is reasonable? What can you expect? How much money can you get from your investments? I get this question all the time, and I thought, you know what? I think it's time we addressed it. How much you can get from your investment depends, number one, on how much you are investing and the returns of your investment. So today I'm going to talk about 3 different types of investments and the returns that you can expect from there. I'm going to talk about savings accounts, I'm going to talk about retail savings bonds, and I'm going to talk about shares that pay dividends. Let's start with savings accounts. I think all of us know what savings accounts are. We've got the whole savings game down. Go to the bank, you open a savings account, you put in some money, and you earn an interest rate. And I've heard and I've seen on social media, people are always complaining saying, I put in X amount in my savings account, and after the end of the year, I get back X amount, and I was so disappointed. Well, you're disappointed because maybe you didn't understand, number one, the interest you're going to get on the money that you invested. So guys, expectation must meet reality. Next, so I'm going to show you in the next slides what you can expect to earn from a savings account that gives you an interest rate of about 4%, which is what most accounts would give you, right? Most savings accounts will give you anywhere between 2%, 3%, 4%, 6% if you're lucky, right? So let's run those calculations. If, for example, you have a savings account that has 4% annual interest, the return per month would be 4% divided by 12 months, right? That will give you a rate of 0.33% per month. What this means is that if you have 100 Rand saved, that 100 Rand will earn 33 cents per month. If you save 500 Rand, it means that 500 Rand will earn 1 Rand 65 per month. If you save 10,000 Rand, that 10,000 Rand will earn 33 Rand per month. If you save 100,000 Rand, you will earn 330 Rand per month. And if you save 1 million Rand, you will earn 3,300 Rand per month. Savings accounts offer very low returns, but they're also very low risk. What this means is that if you put in your money today, it's 10,000 Rand or 100,000 Rand, whatever money you put in, you are almost guaranteed that that money will be there at the end of the year or whenever you need that money, right? Especially flexible savings accounts, very, very low risk, but they also offer low returns. So what are savings accounts good for? I know people are ready to throw away savings accounts like, hey, it's a waste of my time. Why am I saving money? I want huge, massive returns. That's the attitude of people, right? Well, not so fast, guys. Just hold on a bit. Savings accounts do have a purpose. And what is that? Short-term savings. So if you need your money in a very short space of time, then savings accounts are the way to go. And by short-term, I mean anything from 0 to 6 months, a year, or even 2 years. Now, if you want your money to grow over long periods of time, savings accounts have a problem. What is that problem? Inflation. Guys, we all know the effects of inflation. Things get more expensive as the time goes on. Your grocery bill grows higher. Your rent costs more. Electricity costs more. That's the effect of inflation. So if your money is stuck for too long in a savings account, it means that it is losing against inflation. And by too long, I mean anything above 5 years. So let's speak about RSA retail savings bonds. And I realize that people don't know much about this because there's a post on my Facebook page where I posted about assets versus liabilities. And I remember I nearly got slaughtered. People are very emotional about liabilities. But anyway, that's besides the point. So under the assets column, I mentioned bonds as an asset. And someone was like, do you mean a home loan? And I was like, no, I mean bonds as an investment. And then I realized, okay, I think I need to explain it further. So what is a retail savings bond? Basically what it is, you invest your money with the South African government. The government takes your money, they go and build schools, they go and build hospitals, fix roads, and build infrastructure. And then at the end of an agreed term, they give you back your money plus interest. So RSA retail savings bonds work in a very similar manner to fixed deposit accounts that you get at a bank. So if you understand how a fixed deposit account works, then you pretty much know how an RSA retail savings bond works. So the next thing people would ask is, so where do you open these accounts for retail savings bonds? Well, you can open them at your local post office, South African post office, or you can go online to rsaretailbonds.gov.za and you can open an account there. The minimum that you can deposit is 1,000 Rand. And these deposits are lump sums, so you're not going to be able to put in 1,000 Rand this month and then go in next month and put another 1,000 on top of that 1,000. What would happen is that this month, if you open with 1,000, it's fixed for the period that you choose. If you come next month with another 1,000, you are starting a new investment, so you're not adding on top of the already existing one. There are two types of RSA retail savings bonds that you can buy. There is the fixed rates, and then there is the inflation-linked rates. Okay, so what are the fixed rates? I think this one, you might have guessed it. It works just like your fixed deposit account. So there's a 2-year fixed rate, 3-year fixed rate, as well as the 5-year fixed rate. So currently the 2-year fixed rate is 6%. The 3-year fixed rate is 6.75%, and the 5-year fixed rate is 8.25%. Not bad, not bad, not bad. Actually, guys, last year in March, the 5-year fixed rate went up to 11%. It was for 1 month only, but it went up to 11%. So the clever kids, the kids who were watching for opportunities, who had the lump sum, who had the money ready, they went in. So what this basically means is that at the end of the 5-year period, they would have almost doubled their money. That's so wild, guys. That's so wild. Don't worry. If you missed the train, don't beat yourself up, all right? 8.25% is still quite a decent rate. So those were the fixed rate. Then we've got the inflation-linked rates. These ones are slightly different from your fixed rates. And the difference is that they move, or you are paid according to the current inflation. Okay, so the inflation-linked 3-year bond right now is quoted as 2.25%. Whoa, before you scream and say, what? That's too little. Okay, they will pay you that 2.25% plus adjust your money to inflation. So if inflation is 4%, it means you are actually going to be getting 4% plus 2.25%. Do you get it? The other inflation-linked bond is the 5-year one, and it's currently 2.75%. So again, if inflation is 4%, it means you're actually getting 4 plus 2.75, which is 6.75. It's actually almost, no, it's not. I almost said it's almost neck and neck with the fixed ones. It's not. Let me not lie. And then there is the inflation-linked 10-year bond, which is currently offering 4%. Meaning that if inflation at the moment is 4%, you are getting 4 plus 4, which is 8%. But remember, guys, inflation doesn't stay the same. Sometimes it goes up, sometimes it goes down, but your money will always be adjusted to inflation. And they'll give you the extra rates that they've quoted there on the website. So what you should know about retail savings bonds is that if you are below the age of 60, you can choose as the investor whether you want the interest payments to be paid out to you twice a year, or if you want the interest to be reinvested and only given back to you at the end of the investment term, plus your capital that you invested at the beginning. The current 5-year fixed interest rate for government bonds is 8.25%, as I've shown you. If you're below the age of 60, sorry, not 65, 60, you can only receive income twice a year if you choose, making the return 8.25% divided by 2, which is 4.125% every 6 months. It means if you invest 1,000 Rand, you will earn 41 Rand 25 cents twice a year. If you invest 5,000 Rand, you will earn 206 Rand 25 cents twice a year. If you invest 10,000 Rand, that will be 412 Rand 50 twice a year. If you invest 100,000, that will be 4,125 twice a year. And if you invest 1 million, it will be 41,250 Rand twice a year. However, if you're above the age of 60, you can choose to earn monthly interest payments from your capital investment. In fact, this is how a lot of pensioners do it. They can actually choose, if they're above 60, okay, to get their monthly interest paid out. So what are the risks with these retail savings bonds? Well, one of the risks is inflation. Inflation is always a risk. So for example, hey, I'm excited about this 8.25% interest for 5 years. I go in with my lump sum, I put in my money in there at 8.25%. And then what does, is it Tito or Lesicha? Who changes the rates? It's Lesicha, ne? Yeah. If he wakes up tomorrow and says, no, shame, you guys, the ride is over. This thing of interest rates being so low, it's over. We are increasing our interest to 10%. Guess what? In the short term, it means that my 8.25% investment is losing against inflation. But after 12 months, you can reset. So let's say they increase the fixed rate to a higher interest rate. You can ask them to say, can I have that high one? You can do that. Are retail savings bonds safe? I would say they are relatively safe, okay? Because it's the government that you're investing your money with. The chances of the government running out of money completely, it can happen. I'm not saying it's impossible. I think the government of Argentina did run out of money and they defaulted on many of their obligations to investors. So it does happen, but in South Africa, I think we do have a good monetary policy, and the chances of our government defaulting 100% on all their obligations is quite low. Guys, the government is the guys that print money, ne? So if they are owing you money, what do? They'll just print it and give it to you. Biggest risk with bonds is inflation. Now, with savings accounts as well as retail savings bonds, over long periods of time, unfortunately, they do worse than property investments and stock investments. So if you want to invest for long periods of time, like 10 years, 15 years, 20 years, 30 years, your best bet would be stocks as well as property investments. But there's no harm in diversifying, right? You're gonna have savings in a savings account. And you can also have bonds. And you also have a little bit of property investments and a little bit of stocks. So a little bit of everything does not hurt anybody. Last but definitely not least, we're going to be talking about dividend-paying stocks. The reason why I'm saying dividend-paying stocks, there are stocks that don't pay dividends. So if you are a dividend investor, obviously you're going to have to look for companies that do pay dividends. But you must make sure, guys, that these companies have a track record of paying. So they have paid in the past 3 or 5 or 6 or 10 years or more. Also, don't just buy one company, because anything can happen to one company. Diversify and spread out your risk. So if you're going to buy Vodacom, you're going to buy another stock, maybe it's a bank stock, and you're going to buy another stock, maybe it's a retailer. You buy another stock, maybe it's a mining stock, so that your risk is spread, because different events affect companies differently. As we've seen, COVID, yay, some companies were hit and they're still on recovery mode even today, but others thrived. When it comes to dividends, the most important metric or measure is the dividend yield, guys. Dividend yield is a financial ratio that shows how much a company pays out in dividends each year compared to its share price. It is a percentage that is calculated by dividing the amount of dividends paid per share in a year by the share price. So for example, if a company's annual dividend is 2.50 Rand and the share price is 25 Rand, the dividend yield is 2.50 Rand divided by 25 Rand equals 10%. So dividend yield can be 2%, 3%, 4%, 5%, 6%, etc. And what that means is that if a company is paying 6% in dividends, it means for the entire year, your total dividend payments are going to be 6%. 6% of what? The share price. I've seen people saying 1 rand dividend is too little. And I'm like, hey, bana, too little according to what? If a company's share price is 10 rand and the dividend is 1 rand, it means that the yield is 10%, right? 1 divided by 10 times 100 is 10%. So it's actually high. I've seen people saying, oh, company X is paying 3 rand, and then everybody runs, oh, 3 rand in dividends, only to find that the yield is only 0.5%. Where are you going to find dividend yield? You go to MoneyWeb. There's also a website called Share Data. There's also Simply Wall Street. Hey, but I don't know where they get their calculations from. But I checked, I'm like, oh no. Some of the yields that they quote, they are quite high. They're not what is actually on the ground. So you have to double check. So how much can you earn from dividend stocks? How much you earn as dividends depends on the dividend yield and how much you've invested. If dividend yield is 8%, for example, and you invested 100 rand, you will earn 8 rand for the whole year. If you invest 1,000 rand, you will earn 80 rand for the whole year. If you invest 10,000 rand, you will earn 800 rand for the whole year. If you invest 100,000 rand, you will earn 8,000 annual dividends. And if you invest 1,000,000 rand, you will earn 80,000 rand for the whole year. And another thing with dividends, guys, be careful of chasing dividend yields that are too high. If a company is paying dividends that are too high, what it could mean is the share price of that company has tanked, has crashed. They were maybe at a high share price, maybe 50 rand per share. I'm just giving an example. And then that company suddenly crashed, something happened, and now the shares are selling at 5 rand each. So obviously the yield of the dividend would be quite high. Remember, the dividend yield is calculated according to the share price. So if the share price drops, the yield shoots up like crazy. So what is an acceptable dividend yield? Okay, 2%, 3%, 4%, 5%, 6%, 7%, 8%, it's decent. 9%, I've seen this, right? But then I start to get red flags. When I see dividend yields 14%, I'm like, 15%, yo, 20, because companies pay dividends from their profits. So a company goes, sells products, they generate revenue, and then from that revenue, they're going to pay taxes, they're going to pay salaries. If they've got employees, they're going to pay back some of the debt payments. If they've got debts, whatever they have left over, those are their profits. And they've got a choice. They've got a choice to pay out the profits to investors, or they can use some of that profit to reinvest into the business to grow. And ideally, as an investor, you want your company that you're investing in to grow, right? You're not so greedy to say, I don't care. Let's drive it to the ground. Let's take everything. It's in your best interest that the companies that you're investing in also do well, that they reinvest in themselves, self-love, self-care. Because if a company is not reinvesting in itself, what's going to happen? They're going to stop growing. And eventually, they'll have no dividends to give in the first place. When I was still a newbie investor, I was like, yo, such a high dividend yield. I invested. And then when I started learning more about investing, I saw that they are paying out more than 90% of their profits in dividends. And then I was like, this is not sustainable. It means that they're not growing, they're not expanding into new markets. Maybe they're not even advertising, they're not marketing to new clients. They're stagnant. So they're just throwing money at investors like, nice. Yeah, people can be happy. But what about the future? There's a trade-off. You must always check the companies that you're invested in that are paying dividends. What is their payout ratio? What I mean is, of the profits that they're earning, what percentage of those profits are they paying back to investors? And what percentage of that profit are they using to reinvest into the company itself? Having said that, there are other types of investments that do pay out high dividends because of legislation. These are real estate investment trusts. So real estate investment trusts by law pay about 75% or more of their profits as dividends to investors. Which ones are these real estate companies? I'm on MoneyWeb right now, and companies like Capco, Emira Property Fund, Fairvest, Growth Point, Hyprop, Liberty 2D, Oasis, Redefine Properties, Resilient, Safari, SA Corp, Storage, Stenprop, Tower, Vugile. These are not all of them. And by the way, this is not financial advice. However, an interesting thing has happened recently. These real estate guys have not been making money because of COVID. Well, actually, they hadn't been making money for quite some time. And COVID just came and just... Think about it. People, especially last year during heavy lockdown, there was a lot of default in terms of rental payments. And even now, office parks, some of them are sitting empty. These companies are not collecting rent. From office parks, from residential, from even retail, your malls, your shopping malls. Shopping malls are receiving less and less visitors because of COVID and all of that. And let's not even mention the tourism sector. Shame. We don't have tourists. Okay, maybe we do, but they're not the same as before COVID. All of these factors have caused the darlings of the past. Real estate investment trusts were the darlings of the stock market because, you put in your money, you get a high dividend payout. But it's not the case. Most of them are struggling with income. That's why it's important to diversify. When something affects one sector, you do have other investments that are still paying you dividends that are a different sector. As you might have already noticed, for you to earn significant amounts of money, either in interest payments or from dividend payments, it means that you have invested a lot of money. Most people who are enjoying income from their investments today probably started investing long ago, before you were even born. Those madalas that you see sitting at Magan Bean in the morning, when you're working, you're like, don't these people have jobs and where are they getting money? They invested long ago. Their lump sums are huge. People always say, okay, but I've got 100 Rand. How much income can I get? No, you are not going to get income from 100 Rand. You're not. It's going to be very little. The income that you're going to get from 100 Rand investment, or even 2,000 Rand, or even 10,000 Rand, it's not money that you're going to write home about. As a young person, you have not inherited a lot of money and you are looking for income. Just accept the fact that maybe the income might not come now. And what you need to be doing right now is to focus on building. I think a lot of people are in a hurry. I think instant gratification amongst young people is a pandemic. We've got COVID here, and on the other side, we've got instant gratification. People are simply not patient. They're simply not patient. And it's like, okay, but you're going to be still alive. 10 years from now, you'll still be here. 20 years from now, you're still going to be there. 30 years, you're still going to be here. You're going to be around for a very long time. You're going to be there. We are going to be together in the future. So right now, as young people, most of us are in the growth phase. I know there are some people with lump sums, with inheritances. They've got multi-millions already. Sharp, those guys, they can live off their investments. They are fine, right? But some of us are in the growth phase. We are not yet at the income phase. Our investments are not yet at that level to sustain our lifestyles. So what are we doing right now? We are building. Every month we get our paychecks. We take some, we invest. Every time we get a bonus, we take some, we invest. Anytime we get a SARS tax refund, right? Hey, by the way, it's tax season now. We take our refunds, we invest. Anytime we've got side gigs, we take that money, we invest. Don't be discouraged. If you've got 100 Rand to invest, invest it. If you've got 500 Rand to invest, you can only afford 500 Rand per month. Invest it. You can only afford 1,000 Rand. Invest it. And when you get dividends, what do? You reinvest them. When you earn interest, you reinvest it. The time to chow will come. Okay, guys, we're going to end it here for today. If you want to start investing but you need guidance, I do offer one-on-one coaching as well as group sessions, so you can contact me, or you can buy a copy of one of my ebooks on investing or personal finance. You'll find my details in the description below. If you enjoyed this video and you want to see more of such content from me, please subscribe to this channel so that you can get a notification when I post a new video. Until next time, I'll see you guys. Bye.